business cycles. So we didn't really cover the Lucas model. We did talk about his overlapping generation model. But even though we didn't cover it, one of the criticisms of these type of models, meaning the Lucas model, and many of the models that we've covered, is that all the money that they talk about is outside money. That means it's the monetary base, and in our example, there's either some central bank just creates some money and there's a fixed quantity and that's it. Or it's just a transfer from some benevolent entity, and he just gives money to everybody one period or every period, whatever it might be, and they go from there. That's called, in terms of what we like to think of models as outside money. That money comes from a central bank or something outside the system and is inserted into the system. We're going to talk today about what's called inside money. If you've ever taken a money and banking class, you know that banks create money by making loans, right? And that creation of money increases the money supply. Banks take deposits, and they go ahead and out of those deposits they make loans, knowing that at any one time all the depositors are going to come and excuse me, and ask for the money at the same time. Well, they can basically make out loans for that money that they have, right? And excuse me. And they create money in that way. In that same way, when I make that first loan from those initial deposits out of the monetary base, well, guess what? Those people that took the loans, they need to do something with that money. They either invested in some kind of real business, but the point is that money that they loaned out ends up back in the banking system as deposits for some entity. Either the company that borrowed it deposits immediately, or they bought something and that person who sold it to them deposits that money. Well, that increases their deposits and they make more loans. The amount of actual money created from that initial, from those initial deposits, or that increase in the monetary base, right, increases the money supply, and the amount it increases is some multiple, and therefore we have a money multiplier. We're not going to talk much about that today. But that's the definition of inside money, and it creates money inside the system, right? And central banks rely on that inside money or that financial intermediation to increase the money supply and encourage economic activity. Okay. So models that focus on the real effect of fluctuation of inside money, that we just talked about, are very different from the Keynesian and new Keynesian type models, or the Keynesian models that we talked about. We didn't really talk about new Keynesian models. Well, actually we did, because we talked about rational expectations, and the only difference is we apply rational expectations to Keynesian models. So with these models with inside money, the nominal price reflects the value of outside money, right? The monetary base, the liabilities of central banks relative to goods and services. The lower liquidity of inside relative to outside money is reflected in the endogenous interest yield on inside money, the interest rate on what banks lend out. Fluctuations in the average price level results from variations either in the supply of outside money, the monetary base, or the demand for outside money as immediate exchange or as bank reserves. Right? And bank reserves, if you're not familiar with that term, is simply the amount of money that banks keep on hand that they don't lend out. Because although not all depositors are going to come in the same day, on any given day, they have to pay out some deposits. So they have to have some reserves, some buffer right? In case a lot of people come on that one day or whatever to take the money out. Perdón? Required reserve, sí. Okay.
I thought things didn't influence money.
I'm sorry?
The things model didn't monetary.
You're right in the sense that Keynes himself didn't talk much about money. He did talk about money, but he didn't talk much about money. In fact, the early debates between Keynesians and monetarists, a guy named Milton Friedman, was whether money had a real effect or not. But in general, those two schools of thought, you'll see some old economists talk about them like different schools of thought. They basically merged, and they believe that money and fiscal policy has an effect. Some Keynesians might believe that fiscal policy doesn't have much of an effect and they're spouting out. And some may believe that monetary policy doesn't have much effect. But the school of thought as a whole basically now recognizes that both have somewhat of an effect.
Joint effect.
Huh?
Joint effect.
Not
by
well, no, either or could have an effect. In other words, you can have stable monetary policy and during a recession increase in fiscal policy, and it's believed that increase in fiscal policy is a great job when you get the employment. Same thing with the money supply. You can keep fiscal policy steady, increase the money supply, and that'll have an effect. Okay. The fluctuations in average price level results from various variations, either in the supply of outside money or demand for outside money as immediate exchange, or bank reserves, however incomplete or lagged adjustment of nominal prices. To excess supply or demand of outside money play no role in linking inside to real variables in the model. In other words, it's kind of assumed that it doesn't really matter. The author claims that there's literature that has an empirical linking of monetary disturbances to business cycles that's stronger than the inside component, i.e. when the central bank increases the monetary base. What really matters is banks making loans. So Rush has presented evidence that during business cycles in the gold standard era were linked to fluctuations in inside money, right, bank liabilities, and not correlated with the monetary base, the amount of gold there was, or the exchange rate between gold and money. Okay. Michigan and Bernanke have presented evidence that the collapse of the banking system played a large role in the Great Depression. I think that's pretty much accepted. Most of the massive decline in the U.S. M1 money supply at the time took the form of decreased checkable deposits rather than a decrease in the monetary base. The monetary base stayed pretty much the same during the Great Depression, because the amount of gold the U.S. had stayed pretty much the same. Although he doesn't want to make too much out of it, the author uses the following regression to show that changes in M3 right here, right, have a positive effect on, right, real GDP. Now he goes ahead and for that Australian data, he adds the monetary base, right? And you see that the monetary base in this case, right, has a negative sign and is not significant. Right, the standard error is on parentheses. Now there's some problems with this regression in that obviously M3 and the monetary base are going to be highly correlated, so it's hard to distinguish between the two coefficients, but it is evidence that the monetary base doesn't matter that much, although it's not really robust evidence. Okay, there have been two strands of literature focusing on the real effects of fluctuations in outside money. Some authors, such as Brian Diamond and I always mispronounce this, Dybvig, have concentrated on explaining bank runs as occurred during the Great Depression. The basic idea is that bank liabilities are short-term, their assets are long-term, right? And they have to pay depositors cash on demand in exchange for the liabilities, the deposit liabilities. However, many of the assets of the bank are longer-term loans, like mortgages, etc., business loans, and they can't rapidly be liquidated. Furthermore, if they're forced to unload those loans in what they call a fire sale, well, the value of those assets are going to be sold at a discount, probably a big discount. And that's going to, of course, reduce the assets a bank has and make them insolvent. So it makes them, as they say, well, I said insolvent, making it difficult for banks to meet their obligations in exchange for cash for their liabilities.
Basically, what happened to the banks during the 2008 loans.
There really wasn't big runs on banks during 2008, and part of the reason for that is now bank deposits, or these federal bank deposits, and most state bank deposits aren't sure. I mean, you don't have to worry about the bank going bankrupt and you losing your money. The government will figure out a way to get you your money. They'll either pay you directly, or what they usually do is they have another bank come in and buy the insolvent bank's asset at a discount.
Basically, buying the deposit at it.
Yeah, well, yeah, the government basically have them buy it. Basically forces the banks buying them to take a small loss, but in exchange for good standing with the federal government, Federal Reserve, etc. Normally, only a fraction of a bank's customers wish to claim their deposits on any given day. However, if customers come to believe that the bank might be able to not be able to meet its obligations, and they all go to get their money out at the same time, the bank fails. And that belief, right or wrong, that the bank's about to fail becomes a self-fulfilling prophecy. So even strong banks, if there's incorrect information out there, might have a problem if there's a bank run. So as banks call in their loans to meet the bank run, firms are likely to fail unless there's an alternative source of financing. Depending on the contract you have with the bank and your loan, if the bank can call in that loan at any time, well, businesses have a problem. They have to pay off their loan immediately, and if they can't get a loan somewhere else, basically they have to file bankruptcy. Investments will be adversely affected, and the economy is likely to slide into a recession or a depression. Williamson, Bernanke, and Gentler have focused on the least extreme episodes of bank runs, or basically people coming to get their money at the same time. They suggest that normal fluctuations, it might be someday that a bunch of people on the same day for uncorrelated reasons decide to go take their money out of the bank. And that basically is what we call a normal fluctuation. It's for whatever reason, on a few given days, people decide to take the money out of the bank. They emphasize the pro-cyclical movements in the number of bankruptcies as a key indicator of the role of financial intermediaries initiating and propagating business cycles. Okay? So here we have another possible explanation for business cycles. Of course, those bankruptcies, it's unclear if those bankruptcies are internal or external. They may be external. In other words, that might be the first part of the business cycle, the bankruptcy. And of course, the financial intermediaries just add to it because, well, their asset value decline and they can't make that as many loans. Okay. The question is, bank lending special? I would argue that it's becoming less and less special, but that doesn't mean it's not important. In other words, well, I can say another way, that the banking industry itself is less important because now there's more information out there, and because there's more information out there, there's other sources of financing. It doesn't necessarily have to come from the bank. They argue that intermediaries provide a unique service as a result of asymmetric information between borrowers and lenders. The symmetries are also a source of bankruptcy for firms borrowing from intermediaries. Okay, so we're going to use Williamson's model of bankruptcy. All loans and investments last for only one period. A separate firm undertakes each investment, so you have a bunch of firms. There's a continuum of firms indexed by the productivity of their technology, right? That'll be the alpha. And firms cannot be replicated. Otherwise, the best firm we have clones of all the best firms in the replication. So each firm has an ex post per capita output as follows. Epsilon, well, you can think of epsilon as what they're paying back on the capital. Capital to the alpha, and of course, what's left over after depreciation of capital. Where epsilon is uniformly distributed from 0 to some maximum number, we'll call it epsilon 0, and is known only to the firm. They'll always pay the firm to claim. Now, this is after the loan, of course, that epsilon is equal to 0, and they're offered the lender the collateral on the loan, 1 minus delta K, which will fall short of course, what the loan is worth, interest plus principal. When the real loan interest rates are positive, of course, in this environment, financial intermediaries arise in a part of the specialist form that can monitor these firms and determine what the probability of bankruptcy is. Okay. By incurring the monitoring cost, we'll call it zeta, a bank can determine the true ex post productivity of the investment in the absence of an intermediary. Each of the indirect lenders of the firm, i.e. the depositors, would have to incur the monitoring cost. In other words, every person would give or loan the firm individually, and then it would be up to those persons to monitor the business. And that's basically what the bank offers, a monitoring service. The intermediary is a delegated monitor for each of the depositors. So there's going to be a level of epsilon, we'll call it epsilon star, such that if epsilon is greater than epsilon star, it'll be in the interest of the firm to pay off the loan. Right? While if there's some epsilon below epsilon star, the borrower defaults. It just says here, have the collateral. In the default state, the bank pays the monitoring cost of zeta and receives the net income, right? Epsilon K alpha plus 1 minus delta K minus the monitoring cost zeta. Okay. So the state where monitoring occurs is interpreted as bankruptcy, right? I'm going to use, or he uses H to denote the nominal interest rate charged to firms that can go bankrupt. And I'm going to use pi as a measure of inflation. Notice it's actual and expected, because we're not dealing with expectations here. We assume that we know what inflation is. Firms choose capital, the initial capital, and a default level of productivity epsilon star to maximize profits, or basically the following integral. 1 over epsilon 0, remember epsilon 0 is the maximum epsilon that they can choose to have. And I take the integral from E star to E0 times EK to the alpha plus 1 minus delta K minus 1 plus H, where H denotes the nominal interest rate charged to firms, over 1 plus pi, where pi is inflation, times K0. So I take that integral, subject to the constraints. Okay. So at E star, the firm is indifferent between declaring bankruptcy and paying off the loan. Right? If it's below E star, they declare bankruptcy. If it's above, they pay off the loan. So that makes it equal to 0, and therefore I can write the equation epsilon star k to the alpha 1 plus delta k equal to 1 plus h over 1 plus pi k0. Okay. Now, that's important because we're going to use this this logic later on. So remember it, I'll come back to it. So I substitute this into our objective function. In other words, I'm substituting it right here to get rid of the h. And I get the following. Basically, I'm just separating out the integrals. They're all still from epsilon star to E0, right? And each individual part. But notice, even before we do this, that some of these things would just cancel out anyway, this and this. But I go ahead and do the math anyway before that. Take the integrals and expand them out, right? I get 1 over epsilon 1/2 epsilon squared k0 plus 1 over epsilon 1 minus delta k0 epsilon 0, etc. All of that. But if I notice in all of these that a lot of these things cancel out. For instance, here I have 1 over E0 1/2 E0 squared k0 alpha. Well, that's essentially the same as this, except we don't have the 1/2. So it's 1 over epsilon 0 k0 alpha epsilon 0. So epsilon 0 times epsilon 0 is epsilon 0 squared. So in this case, I'd have negative 1/2. This thing right here. Right? Over here, I have 1 over epsilon 0, 1 minus delta k0 epsilon 0, and over here I have the same thing, but with the minus sign in front of it. Those two things cancel. Here I have the same situation I had before, but with epsilon stars. And over here I have what's left over after depreciation with the negative sign in front of it. And over here I have the same thing with positive sign, they cancel. So I do all that, and I get the following, which is this. And basically, if you look at that, that's just a quadrant, right? Just a quadratic, right? I have the square here, the square here. So I can expand this out. I can rewrite this as this times 1/2 and this minus 1/2, right? Just to see that I can rewrite that as k0 alpha over 2 epsilon 0 epsilon star minus epsilon 0 squared. Since this term right here is squared, it's going to be the same as the following. Now I'm not sure how they got this, but the math is right, and this is just something that we can do with logic. So taking that, I can go back to plugging that into our objective function. But first I want to talk about the expected return to the bank minus the cost of their intermediary services. And that's going to equal the payment to depositors. I'm going to assume a fraction, rho, of deposits are held as non-interest bearing reserves by the bank, and that the cost of intermediary services are a fraction of and we're going to call that fraction pi of the levels of deposits. So if R is a return on deposits, right, the expected nominal return to the bank will be I is going to be equal to R plus chi over 1 minus rho. So I plug that back into my objective function. Right. I use the objective function and this constraint here, which we just went over, in Lagrangian, and I make sure the sub-equation 4, right, I plug that in here to eliminate h, and I get the following in Lagrangian. I have my objective function that I told you guys a while ago, how we got to it, plus my Lagrangian multiplier 1 minus delta k0 plus epsilon star K0 alpha minus epsilon star squared K0 alpha over 2 epsilon 0 minus epsilon star over epsilon 0 times zeta minus 1 plus I over 1 plus pi, where I is, of course, the nominal return to banks and pi is the inflation rate. I take the first order conditions with respect to capital and respect to epsilon star. And I get equations 8 and 9. Right? I take those two and I do what we always do. I take the lambdas. I solve for lambda, set them equal to each other, get rid of the lambdas, do the algebra, and I get the following. I get 2d, which d, I'll explain in the next slide what it is, times epsilon 0 k0 minus k0 to the alpha e0 squared plus zeta times e0 minus e star. Of course, that sets equal to 0, and therefore e star k0, e0 minus epsilon star over 2 minus epsilon star zeta minus alpha epsilon 0 d k0 equals 0, where d is equal to the following, or well, actually it would be delta plus I minus pi over 1 plus pi, the whole thing over alpha would be equal to d, therefore alpha d is equal to this. So for a given I and d, right, our first order conditions can be solved for k0 and epsilon star. So equation 4 can be solved for h, right? Thus, the firm side of the model, the supply of output and the demand for capital, can be solved as an implicit function of the interest rate or the return on bank loans. Any shock that affects the demand for deposits from households, the cost of intermediation, that's chi or rho, or equilibrium interest rates will affect the supply of bank loans, the number of bankruptcies and the level of output. An important feature of Williamson's model, however, is that intermediaries finance all investment. More generally, firms deny bank loans won't be able to finance their investments directly from the capital market and may be displaced by firms that have access to that finance. Household borrowing constraints and bank lending. I've argued that, or we have argued that household credit constraints, that is restrictions on household borrowing, are central to ensuring fluctuations in bank finance have a significant impact on the aggregate economy. If not, I could just go, businesses could just go directly to consumers and have each consumer pay a little bit or loan them a little bit, i.e. the bond market. But not all not all firms have access to the bond markets, therefore they have to go to some kind of other intermediation, financial intermediation banks, right? Because the cost of getting loans from individuals is costly, right? So banks harness the demand for the medium of exchange to finance investment and affect indirect claims to capital circulate in place of outside money, right? You can think of checks, right? In an economy with only outside money, the capital stock merely reflects the desire of consumers to save for future consumption. It might be thought, therefore, that an economy with inside money will support extra capital and produce more output. There may also be a presumption that shocks to the demand for inside money or changes in the bank costs would affect the supply of bank loans and make investments more vulnerable to financial disturbances. If the equilibrium capital stock is higher in an economy with inside money than the marginal product of capital, and thus the equilibrium real interest rate must be lower. In the absence of household credit constraints, the restriction on borrowing, intertemporal arbitrage would tie the riskless interest rate to the household rate of time preference. Right? Increased household borrowing would compensate for increased lending from intermediaries, and the equilibrium capital stock would be unaffected. Furthermore, if households have sufficient access to capital markets to stabilize real interest rates, the equilibrium capital stock should also remain largely unaffected by shocks and adversely affect the size or efficiency of intermediary industries. A contraction in bank finance would be accompanied by disintermediation, i.e., we go from bank financing to individual financing, or an increase in loans to the firm from other sources. I also discuss the intertemporal general equilibrium model, where an asymmetry of information between entities and firms and the possibility of bankruptcy restricts some firms to bank finance. I assume, however, that households can also lend directly to some firms. Furthermore, some firms can either borrow from banks or directly from households, or households do not face a credit risk. The stationary real interest rate on direct loans from households is tied to the household rate of time pair pieces. Arbitrage by firms able to choose their source of finance ties bank interest rates to real interest rates on direct loans. Thus, the household rate of time preference becomes a key determinant of all real interest rates and therefore the marginal product of capital and the capital stock. Financial shocks that change the supply of bank loans have few effects on general equilibrium of the economy. Changes in direct investment in firms by households and changes in household borrowing substantially offset changes in the size of the banking sector. Disintermediation would become irrelevant only if the economy arrives at a corner where all firms borrowing from banks have no alternative source of finance. Okay, so if households cannot borrow, right, however, then I show that the stationary equilibrium on real loan interest rates is below the household rate of time preference. The equilibrium capital stock is therefore higher than in an otherwise identical economy with neither inside money or credit constraints. Households willingly hold inside money and loans at such a low interest rate in order to compensate, in order to finance consumption, or self-insure against unanticipated fluctuations in liquidity. Furthermore, real interest rates are affected by changes in bank costs or the demand for inside money. Okay. Since the demand for direct loans to firms is itself related to the liquidity needs, disintermediation. By the way, let me make clear what disintermediation is. It just means that you're going outside the bank and borrowing directly from people. Los agentes que consumen. So disintermediation becomes less effective from insulating firms from changes in the supplies of bank loans. Changes in real interest rates are accompanied by changes in equilibrium capital stock, output, the number of bankruptcies, and the term of loans offered to borrowers liable to create bankruptcy. So getting rid of banks and providing more information, in this case, doesn't necessarily help in smoothing out business cycles. It is informative. It's informative to consider the way monetary factors and household credit constraints alter the first-order conditions for the intertemporal consumption decisions of the representative households that we talked about. Throughout the discussion, we'll use loans to refer to direct household loans to firms. So when I say loans, that means people giving money to firms or lending money to firms. And they bypass banks, intermediaries. In practice, such capital market instruments could be equities instead of corporate bonds, but it's some type of financing. Inside money yields a positive nominal return while outside money does not. Right? That's what we see in banks. The monetary base, right, they really don't get much interest out of it. In fact, it's the opposite. If both types of assets are to be positive, to be positive demand, then outside money needs to yield additional liquidity services. I assume that outside money is more universally accepted than inside money. You can think of cash being more universally accepted than checks. In the sense that outside money can be used to make any purchases, whereas inside money is unacceptable for a subset of purchases, where you can use your ATM or you can't. The implicit liquidity service of inside and outside money is reflected in positive Lagrangian multipliers from the liquidity constraint. These positive Lagrangian multipliers raise the returns on holding outside and inside money to equal or higher real yields on loans. In other words, they could be loaning it out, or you can hold it. They also drive a wedge between the marginal utility of consumption and the marginal value of wealth. Whether I consume now and worry about my cash flow, or lend that money out. So for a household that's unaffected by credit constraints, the first order condition would be something similar to the following: 1 plus IT minus 1, or IT, right, is equal to beta, the expected value of wealth or the expected value of their indirect utility of wealth in period T plus 1 over the indirect utility of wealth in period 2. Right? That'll apply to the intertemporal consumption versus the saving decision, where V of T is the indirect utility of wealth, and it is the real return on loans. However, the marginal utility of wealth will differ from the marginal utility of consumption by the Lagrangian multiplier, even though it's not in that equation. But that would be the other first order condition. And that'll reflect the liquidity value of monetary assets required to finance consumption. If these liquidity returns are represented by a multiplier, we call it U2, the first order condition becomes 1 plus T inverse is equal to beta, the expected value of the expected utility of consumption in utility C plus 1 minus our multiplier T plus 1 divided by the marginal utility of consumption in period T minus the multiplier in period T. So the marginal utility of consumption exceeds the marginal indirect utility of wealth by that multiplier mu. Hence, the level of consumption will be lower than it would be if loans could be used directly to finance consumption. I can loan money out, but I can't borrow money, right, for consumption. The requirement is to use lower yielding liquid assets, effectively raises the cost of consumption and therefore reduces the amount consumed. The first order condition for a credit constrained household would be further modified by a positive Lagrangian multiplier from the credit constraint. Specifically, if lambda T is the multiplier for the credit constraint, the intertemporal consumption versus the saving decision of the credit constrained household would obey the following: 1 minus IT inverse equals beta, the expected value of the marginal utility consumption period T plus 1 minus the multiplier for liquidity plus lambda T over what was before the marginal utility consumption period T minus the multiplier period. The liquidity multiplier. So the key modification results from the presence of liquidity and credit constraints. However, is that both the value of liquidity and the credit multipliers in proportion of households that are credit constraints in any period depends on the interest rate, IT. As a result, firms effectively face an upward sloping supply curve of investment funds as a function of the interest rate. The equilibrium interest rate and the level of investment can be jointly determined by household and firm behavior. In particular, shocks to the marginal productivity of capital, K alpha, right, and the depreciation rate of capital alter the equilibrium real interest rates, even in a stationary state where per capita consumption is not expected to change from period to period. In contrast, the standard representative agent model, real interest rates are determined by household behavior. Firms face a horizontal supply curve instead of that upward sloping supply curve of investment funds from households at a real interest rate determined by the household rate of preference and anticipated change in household consumption. Right? An economy with inside money and credit constraints, there would be some funds available to firms to finance investments even at very low equilibrium interest rates. Inside money with a positive yield is preferable to outside money with zero rate of return, even when the real yield on inside money is close to zero. Households will hold some inside money to finance purchases, right? That could be made with either type of liquid asset, checks or cash, if you think of. As a result, equilibrium between the supply and demand for investment funds occurs at a low real interest rate that would apply in the standard representative agent economy with neither inside money nor credit constraints. Intermediaries would also finance investments in an economy with inside money but no credit constraints. However, many households would exploit any tendency for real interest rates to decline by borrowing. Such increased borrowing would occur up to a point where households were indifferent between consuming today and consuming tomorrow. Intermediaries would have little impact upon equilibrium interest rates and investment. Increased household borrowing compensates for the increased availability of funds from the intermediaries. In the credit-constrained economy with inside money, the equilibrium real interest rate is very sensitive to shocks, right? Affecting the demand for inside money or shocks to the banking sector that affect the supply of loans corresponding to a given demand for inside money. Changes in real interest rates are accompanied by changes in equilibrium capital stocks and equilibrium per capita output. For example, using his model, doesn't really go into it very deeply, but the real effects of a shock to demand for inside money is bank costs are about 100 to 200 times greater when households face credit constraints. The elasticities of real interest rates on direct household loans to firms, upon which other interest rates are based, and the stationary per capita capital stock with respect to key parameters of the model are in the following figure. Right? So here I have the elasticities of real bank loans. I have here P, the probability of using inside money, and the elasticity of per capita capital. Now notice that the unconstrained, the black, is tiny in terms of elasticities compared to the constraint model. In other words, very inelastic. They use the interest rates on loans in the unconstrained case, but when they're constraints, they have a lot more flexibility, or they choose to be more flexible. And the key parameters include in the figures are the household time discount factor beta, the coefficient of relative risk aversion, gamma, the probability of non-zero demand for transaction services of inside money in any given period, P, right? Remember, that's what P is, the probability of non-zero demand for transaction services of inside money in any given period, right? The utility value of goods which can be bought with inside money relative to goods that can only be bought with cash, and I'll call those goods 5-star. The reserve ratio for banks, rho. The marginal cost of bank services per unit of deposits, chi. The fixed cost of bankruptcy in units of per capita output, zeta. And the coefficient of capital in the Cobb-Douglas production function, alpha. And finally, the per period depreciation rate, delta. Since cash is universally accepted as a medium of exchange, while inside money is not, again, not everybody accepts checks, an increase in risk aversion gamma increases the demand for cash at the expense of inside money. In both the credit constraint and the non-constrained economy, there's a large fall in the per capita demand for inside money. As a result, household risk aversion is a major determinant of equilibrium real interest rates. and the per capita capital in the credit-constrained economy. In the unconstrained economy, however, a large fall in borrowing by less wealthy households and a rise in direct household lending by more wealthy households offsets the tendency for real interest rates to rise. An increase in net direct lending to firms offsets the decline in bank loans, so the per capita capital is virtually unaffected. So in the unconstrained case, right, there's more flexibility, and interest rates aren't affected very much. Right? An increase in the probability P of being able to use inside money to fund purchases reduces consumption uncertainty, and therefore the demand for liquid assets. The same inventories of cash and inside money finance a higher level of per capita expenditures. I can use my credit card to buy stuff now if I fall short of cash in one period. In the unconstrained economy, households substitute out of liquid assets into direct loans to firms. Right? Equilibrium real interest rates fall marginally, and there's an extremely small positive effect on equilibrium per capita capital stock. In the credit-constrained economy, right, the increases in P reduces the average excess liquid asset held by households after goods markets trades. The demand for direct loans to firms, as well as the demand for liquid assets, declines, and the equilibrium real interest rates rise, and the equilibrium per capita capital stock falls. So unconstrained, you see, is more flexible and probably preferred. An increase in the value of goods that can be bought with inside money relative to the goods that can only be bought with cash. 5, raises the demand for inside money. In the credit-constrained economy, the increase in demand for inside money dramatically reduces the equilibrium real interest rates and produces more deposits, and produces a large increase in the equilibrium per capita capital stock. In the unconstrained economy, a large decrease in net direct household loans to firms again offsets the tendency for real interest rates to fall. While the elasticity of real interest rates and per capita capital with respect to changes in bank costs, chi, or the bank reserve ratio, rho, are not large in either economy, they're still about 100 to 200 times larger than the credit constraint. Again, endogenous increases in direct household loans to firms offsets the fall in the bank loans in the unconstrained economy. Okay, what he calls a striking feature of the figure is that household rates of time preferences, 1 over beta minus 1, is the only parameter to have much of an effect on equilibrium real interest rates when there are no household credit constraints. In the other case, right, endogenous changes in direct household lending to firms offset any tendency for real interest rates to change. In the case of changes in alpha, delta, and zeta, stationary equilibrium interest rates are completely unaffected. Right? When we have one constrained case again, because they just switch away from the intermediaries to go to the alpha, and households can of course borrow to consume. By contrast, the credit-constrained economy, alpha and delta are key determinants of the equilibrium real interest rates. In addition, changes in the cost of bankruptcy, zeta, affect only those firms at risk of bankruptcy in the unconstrained economy, whereas zeta affects all firms in the credit-constrained case. So in the unconstrained case, it really doesn't matter that you have bad firms, but when you have the constrained case, bad firms cool down everybody. So a simple partial equilibrium model of the market for loans provides a useful conceptual framework for viewing the results for the credit-constrained economy. Changes in alpha, delta, and zeta can be thought of as shocks to the demand for loans from the firms. Since such a shock would produce a movement along the upward sloping supply curve, the result is a positively correlated movement in equilibrium real interest rates and an equilibrium quantity of loans. On the other hand, changes in the time discount, or in other words, 1 over beta minus 1, gamma, P, theta, and rho, and chi, can be thought of as shocks to the supply of loans from the household and banks. A movement of the supply curve along the downward sloping demand curve from loans then produces a negatively correlated change in real interest rates and an equilibrium quantity of real loans. It's also noteworthy that most of the loan supply shock also produces endogenous movements in money supply, measured as the sum of inside money and cash balances, both inside money and outside money. The average nominal prices are positively correlated with movements in per capita capital. By contrast, alpha and delta produce endogenous movements in money supply and nominal prices that are negatively correlated with movements in per capita capital. The footnote, the change in the probability of check goods demand P is the only exception. There is now considerable evidence, particularly from panel data set, that constraints on household borrowing can explain deviations in observed household consumption from that predicted by the permanent income hypothesis. Remember, the permanent income hypothesis basically, at least in the most basic form, assumes perfect capital markets, right? I can, if this period I don't make as much of income as I'm going to make in the future, I can borrow. That might not be true, right? And that can explain deviations in predictions. Household with relatively higher level of wealth can maintain consumption when income is temporarily low. They effectively self-insure by holding assets they can liquidate in time of need. Right? They go off and sell their bond or stock, and they keep the consumption the same. Households without much wealth, however, appear to have a limit of access to capital markets and therefore tend to display consumption levels that more closely track their current income. Right? We've argued that credit constraints and the presence of demand for inside money and the role for financial intermediations explain many of the currently anomalous phenomenon in financial markets. In particular, they offer an explanation for apparently low risk rates of real interest, relatively high risk premium. Of course, today risk premiums haven't been that high in quite a while, at least not historically. Relatively large fluctuations in real interest rates in the face of smooth per capita consumption profiles, and a large effect on real interest rates with real shocks such as shocks to the marginal productivity of capital. They would also appear to account for large effects on the real interest rate, investments, output of the financial sector, to demands for inside money, the cost of financial intermediation, and the extent of costs of bankruptcy. That's the lecture. Any questions? Nobody joined us remotely, so I'm going to stop the broadcast.